All right. So, time to talk about beta. For all of you out there that use discounted cash flows, the major input into that is beta. And today I'm going to talk a little bit about the way I look at beta. So, let's get started. And for those of you who don't know me, my name is Andrew Stotts, and I'm the CEO of A Stotts Investment Research. Some of you may know me as the worst podcast host of my Worst Investment Ever podcast. I hope to see you there, by the way. So let's get into this. Today's topic is how to determine the beta to use in company valuation. Now, before we get started, let me just remind you that you can ask any question in the chat. I'll be able to see that. And even if it's towards the end of the event, you can add it in there and I'll try to reply after I log off. So feel free to leave any questions in the chat. So first, let's look at the top article of today. Facebook blocks Australian users from viewing or sharing news. Okay, this is interesting. I find this fascinating. Facebook puts the pressure on Australian government. It has to shut down the function to view and share news content in Australia. That's what Facebook did. It even blocked the access to government agencies' Facebook sites. Wow, that's a pretty heavy stroke. So why did they do it? Well, it's been heavily criticized as anti-democratic by Australian population. Facebook responded to the government's proposal of making tech giants pay for showing news on their platform. The proposed Australian law was originally suggested to support news publishers as the profits made with the content that they're creating is mainly flowing to big tech. And, this is not a secret. We've seen the collapse. In fact, I would say we've seen the collapse of media to some extent because they have a hard time monetizing what they're doing. So they have to put it out on social media, and social media then uses it and can collect a lot of revenue from that. And the interesting thing is that the media companies are under a lot of pressure in the US from both the left and the right. The left that wants to break them up, and even Tulsi Gabbard, one of the former candidates for Democratic nominee for president, has filed a suit to against Google and also to break up. And we also have, I believe, there's about 38 governors that have filed suit for anti-monopoly or monopolistic behavior, I think, by Alphabet. But I get ahead of myself. Let's just look at this in a little bit more detail. Whoops, here we go. So Facebook uses Australia to threaten other countries. Australia itself is not a big market for Facebook in terms of revenue. However, with ongoing discussions about a similar law in EU and Canada, Facebook seems to want to send a clear message that if you threaten us like that, we're going to shut it down in your country. We'll see how that works. Now, Facebook, Google, Twitter, and others are only safe at home. In America, they have Section 230, and it's a piece of internet legislation in the US passed into law as part of the Communications Decency Act of 1996. It generally provides immunity for website platforms from third-party content. And it says, no provider or user of an interactive computer service shall be treated as the publisher or speaker of any information provided by another information content provider. So let's get into the topic of the day, how to determine the appropriate company beta. Well, of course, beta is a measure of systemic volatility. We call it risk sometime in the world of finance, but truthfully, it's not really risk. It's just a measure of volatility. And it determines the stock's sensitivity to market movements. And if beta is 1, the stock moves the same as the market. If beta is greater than 1, the stock's more volatile. If beta is less than 1, the stock is less volatile. So we've recently did some academic style research to answer the question, does a stock's beta revert to mean? So what do we mean? Well, we investigated 18,000 listed companies at any point in time on any stock exchange in the world from 2002 to 2020. And our research process, well, we grouped the observations into quintiles. That means 5 groups based upon the level of beta. The highest betas would be in the top quintile, and the lowest beta would be in the bottom quintile. Then we observe what happened to the average beta of these stocks over 10 years. And first thing, if we look at this chart, what we're going to see on the left is in the first year, the highest beta, the first quintile group, stocks had 1.99 beta. And the lowest, the fifth quintile, had 0.27 beta. What's interesting is what happened over time, which you can see here. The highest beta stocks fell to about 1.22 by the time it got to the end of 10 years. And the lowest beta stocks rose from 0.27 up to 0.68. This is fascinating because the first thing it tells you is whatever beta that you see right now is not the beta that you should be using in your valuation. Well, if you look at the bottom right hand of this section of this report, I say that of course when we're valuing a company, we're valuing it to infinity. So really the beta that we're using is the beta to infinity. And what this basically means is that when I value companies and when I advise others to value companies and my students and the people that work with me, I say that generally you want to keep the beta in between a range of 1.25 and 0.75. You can go outside of that range, but just know that you are now going into a territory where it's less and less likely. Now, the other conclusion from this chart is that high beta stocks stay high beta. So nothing wrong with thinking about high beta stocks in a higher beta bucket and looking at them that way. But again, they all revert. Now they revert towards mean. Remember our question was, do they revert to mean? Nope, they do not go to mean as a group. So there we go. That's the research for the day. And I find it fascinating because when we're valuing companies, particularly in the valuation masterclass, when I'm working with students, a lot of times it can get a little bit crazy because if you use the beta that's happening right now in a particular stock, let's say it's 2 times beta, you may come up with a very high discount rate. A very high discount rate will mean the value of that stock is very, very low. And the result of that is that you'll come up with a wrong valuation. So in my book, 9 Valuation Mistakes and How to Avoid Them, I go over this and show that this is a very common mistake. So the way to solve this mistake is to forecast beta to infinity. All right, it's time for the meme of the day. Are you ready? Let's go. The meme of today is the guy sitting there going, "What inflation?" And then you see this giant elephant of inflation. And this is from Hedge Eye, which is Bill Rich who made this one. But it's a great reminder that inflation is looming. And remember also that when oil price starts rising, it is very common that inflation will follow right after that. Now, of course, that is product inflation, meaning the inputs into products and services, but it's not wage inflation. In fact, things could get really bad because with so many people out of work, right? With so many people out of work right now, there's no way we're going to see wage inflation. So people's wages aren't going to go up, but the cost of products and goods and services could potentially go up. And if that happens, it can get very painful. The point is that also, if it starts to cause the government to have to, the long bond to start to go over 2%, 3%, 4%, because obviously inflation is a huge component of that. If it causes that to happen, I think you're going to have to see that the Fed is going to do something to stop that, because we know that the Fed basically can't let the interest rate go too high, because the federal government's funding would explode and the federal government budget would explode. So what have you learned today in this session? Well, the key points. Facebook shows the ability of tech companies to threaten foreign governments, but pressure is mounting on social media companies. And this is a great lesson about how sometimes it's like the story. Think about the story of the person who is really scared about someone's going to break into their house. So they barricade the front door and they put everything in front of the front door. And then the robber just walks in the back door because they didn't barricade that door. And so social media companies, I believe, are not so worried in the US because of their Section 230 protection, but they could come under attack from countries outside of the US. Over the long run, a stock moves like the overall market. indicating a beta of 1. But our reasonable range for a stock's forecasted beta is 0.75 to 1.25. So the bottom line for company valuation purposes, avoid extreme beta forecasts. So let me take you to the last thing. If you want to see how I pick stocks, just download my free checklist. And you can take a snapshot of this screen so that you can go there. And I'll give you a free PDF of the checklist that I use when picking stocks. All right, let's see. Do we have any questions? We'll go and see. Hi, Hillary. Good to see you. Yep. Hi, Louisa. Nice to see you. So I see a question. How do we determine a beta for a specific project since we need it for calculating cost of equity? And sometimes it's not applicable to use the company beta. Excellent question. So it's a project. And I think that the main message that I would get across to you, and I've written about it in my book, 9 Valuation Mistakes and How to Avoid Them, which is over there. My advice is don't worry about the beta. Don't get too overly focused on the beta. Why is that? Because with that beta, you're never going to get it right. So focus on the discount rate. It may be a little bit of beta that you adjust, a little bit of risk-free rate, but I wouldn't worry about it too much. Now, based upon this, I would say that if a project is more risky than the riskiness of the overall portfolio of the company, then you could say that that project has a higher beta. So you can apply a beta specifically to a project based upon the risk of that project. So Hillary says, I think they get attacked because of 230. Yeah, I think so. So Louisa asked, does this range apply to most industries? And my answer is no. This is a general range that we did looking at all companies in the world. So this is a general range. But however, I did test this for every sector. And what I found was that the pattern was the same. High betas fell, low betas rose. And the result of that is that we could see that this did apply in every sector, but the actual level of the beta is going to be different. And by the way, for those people that couldn't scan the barcode, I just included the link to the checklist that I have. So this is an interesting topic. It's something I cover in the Valuation Masterclass, and it's something that I also wrote about in my book, 9 Valuation Mistakes and How to Avoid Them. That one's available on Amazon for, I think, about $10. So again, for those people who want to pick up that stock picking checklist, just scan the code or take a snapshot of that. So this is Andrew Stotz, your worst podcast host of My Worst Investment Ever, saying, I'll see you on the upside.